Hi, my name is Jeff, and today's segment I'll be sharing with you a topic about insured retirement strategy, also known as infinite banking. There are different names people will call it, but it's more or less along the same lines. So how does it work? You're basically investing money inside a permanent insurance policy. So that's the whole premise. Now, what kind of permanent insurance policies are out there? Usually it comes down to two choices, either what's called a whole life product, participating whole life, or a universal life. So where should you choose which one all depends on you and your level of risk and suitability. So let's start with explaining how to invest inside a whole life plan. So when your money is inside the insurance plan, the policy, the money will grow tax-free, which is great. And what's making it grow are the company's dividends, the profits that the companies earn on a year-to-year basis. And those dividends will pay back to your policy, which means your cash values and growth will increase over time. So there's no, the onus is not on you to make it grow, the onus is on the insurance company. So typically, if that's the case, the risk level for a whole life policy is a lot less than the risk level of a universal life policy. Now, you can go with the other route, which is the UL, universal life, and the difference would be that you get to choose where to invest. So the onus is on you now to make sure that the policy performs. So where can you invest when you're putting into a UL plan? You could put it into equity, stock market, you could put it into bonds, fixed income. So anywhere you like, depends on your choice. And you can put it all into one area, one sector, or spread it around. It's entirely up to you. But be mindful though, when you're putting money into a universal life plan, you've got to consistently monitor it. I would say once or twice a year, and you may have to readjust, rebalance along the way, okay? So when you put your money inside those policies, you can now turn it into what's called your own banking system. So you can actually borrow against it, either what's called through a collateral loan. So with a whole life plan, because it's more safe, you can tend to borrow up to 90%, close to 100% of the money that is sitting in there. For the universal life, you could probably borrow up to 60% on average. Just because, again, the person who's lending you the money, the third party, they need to make sure that it's not a high risk investment to lend you the money. But because you're choosing the investments, they have no control. That's why you can only probably borrow up to 60% of the money sitting inside the UL. So it's up to you, whichever you prefer. Now, what happens to the money when you don't use it, the owner passes away, then all of the proceeds will go to your beneficiaries tax-free. Okay, so that's another cool advantage of having your money in the plan. It all comes out as an insurance payout. And in Canada, life insurance payout is tax-free, 100%. The beneficiary doesn't have to report it as income or anything like that. And it's private. Also, it's creditor proof. So if the owner ends up owing money to creditors, it will not affect the money inside the insurance plan. Okay, so it's protected. So starting younger is always an advantage because you are in fact purchasing an insurance plan as the base. So insurance plans has a cost to it, and the cost will be determined by your age, your gender, your health history, all of those factors. So knowing now that the earlier the better, then the best time to start it is now. Okay? Another thing that can deter the qualification process, because not everyone can qualify, is the financial history. So if you ever declare bankruptcy, or even if you have a criminal record, that can really affect the approval chances for you. So that's just a little bit about the topic for insured retirement planning or infinite banking. Any questions, feel free to message me below. Until then, I'll see you next time. Thanks for watching.